Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN Weekly for Saturday, December 26th, 2020. And our top story today, hedge funds nose past the S&P 500. Joining me now to discuss this and a lot more is Tucker Piner with Bloomberg. Tucker, great to see you. Thanks for joining us this morning.
Thanks for having me, Jeff. It's good to be back on.
Yeah, and I should say that normally when we chat with you, you're in London, England, but this week you are back visiting your folks and you're in Sparta, North Carolina. A little bit change in temperature, but glad to have you back here in the States. So let's jump into it, because the purpose of our conversation really today is to get an update on alternatives, but also specifically hedge funds. So I'll just ask you straight out, how have hedge funds performed this year?
Well, it's exciting because we spoke around this time last year and they finished the year strong. And I would say they've echoed that sort of performance from 2019. All strategies from the ones that Bloomberg cover, your equity, credit, relative value, macro, everything is up right now. Some doing better than others, but it's been definitely an exciting time for the hedge fund market.
And so when you look at, oftentimes when we're managing and looking at money, you have a benchmark. And so typically the S&P 500 is one of those benchmarks that we all look to and compare ourselves to if we're a fund manager. How have hedge funds done relative to that benchmark?
So on the equity side, it's pretty competitive. Right now, Bloomberg's seeing the hedge fund equity space come in around 10%. So it's lagging behind the S&P just slightly. Long-only strategies seem to be outperforming all other strategies. But on the credit side, obviously, we don't really try to benchmark different strategies to the S&P. But when we talk about an S&P benchmark, we think of the equity hedge fund strategies, and they're definitely pretty competitive right now.
And would you say, one of the benefits you have by being in London, which is obviously one of the huge financial capitals in the world, is that you get to touch, I say that figuratively, especially in light of a pandemic, but you get to figuratively touch not only U.S., but also European hedge funds and European alternatives.
And the Asian market as well. Yeah.
And Asian, right. So has there been one market, when you look at the marketplace, is perhaps Asian doing better or European doing better? How do you see it?
Well, actually, right now, I think the U.S. market is outperforming its global peers. But a lot of those U.S. funds are investing in, say, a Japanese equity fund. And they definitely seem to be quite competitive compared to a traditional long-only fund. What's interesting is the activist hedge funds have returned year-to-date about 8.2%. So they seem to have really found a way to navigate all these storms that keep being thrown our way. And that's something we continue to keep an eye on, because we do think that strategy is going to receive heavier hedge fund flows as we go into 2021. And
Tucker, the ESG or sustainability, that has become a very large trend. I mean, it's in the trillions and trillions of dollars in terms of new money flows. Absolutely, it's huge. Yeah. So in terms of hedge funds and maybe alternative mandates, are you seeing a lot of interest in sustainability in ESG and maybe working with the Bloomberg team to kind of impart some of those strategies into some of these hedge funds and alternatives?
100%, Jeff. Every conversation I have with an asset owner, whether it be a family office or it be your government pension funds, ESG is always going to be within their investor mandate. The hedge funds are responding to that kind of community activity, and whether it's the principles for responsible investing, we were meeting with them the other day to talk about how we could structure our database to make sure that we're able to accurately monitor these funds and help them promote themselves on Bloomberg. But what's tricky, Jeff, is we're not able to capture hedge fund holdings, and there's no provider in the world that can. So it's how do we properly identify them from a database perspective, put them on our system where we feel it's accurate, and then let them be able to tell their story to investors through Bloomberg, which is our goal at the end of the day, which is how I try to help the funds I work with. Everyone can put ESG in their, part of their prospectus. Everyone can talk about their ESG practices. We're right now trying to iron out, and I'm so glad you brought this up, because it's a huge initiative I'm working on with my colleague in Hong Kong about how we can properly rank these hedge funds, score them with an ESG model, and add them to our hedge fund database. But we're still working on it, actually.
Well, yeah, and you bring up a great point, and we've talked about it with some of your peers in the space. We talked with Bob Colley over Colley ESG about this. I think he's based in the UK as well. How do you grade out whether someone is actually doing what they say they're doing? So, for example, if you are divesting from fuel or gas, oil, are you really doing that? Are you really focused on implementing ESG factors? How do you do that at Bloomberg? I mean, it's a lot of peeling back the onion, I would imagine, and a lot of conversations. But in the age of transparency, hedge funds aren't always as transparent. And how do you go about doing all that?
Yeah. So right now, I think just like everything within the hedge fund and private equity space, it's going to be driven by the investors. This community is going to really need to monitor itself. And so a service provider like Bloomberg, when we're going to go on the record saying, yes, we believe that 50% or whatever number we've come up with in terms of their allocation to ESG focused groups or sectors is they've checked that box. We want to make sure that we're working with the investor community to say, is this company, you're the one who have access to the holdings, are they fulfilling their investor mandate to you? And so I think that's going to be my strategy, is trying to build a network of investors that believe in what Bloomberg's trying to accomplish from a database perspective. And if the investors buy in, so will the hedge funds. And we believe that we can really build an accurate database around the ESG focused market, because that's definitely where the world's headed.
And so when you're talking to investors, you're talking institutional investors, you're talking third-party consultants, but you're also talking
sovereign
family
wealth funds. Yeah.
Right. You're also talking sovereign wealth funds. Thank you. And also family offices. How has the growth of the family office really taken off in terms of alternative mandates? Is there, I keep reading about things like Bitcoin and alternatives and private equity. Is there still interest in mandates through hedge funds and other types of vehicles, not vehicles, but other types of investments?
Fantastic question. Yeah, we actually did a COVID-19 allocator survey. About over 50% respondents came back to us. Of that, 78% were single or multifamily offices. And what was interesting to see is, based on those respondents, which was heavy family office, about 50% of them had already increased their allocation to alternative funds or are planning to increase their allocation. So that's massive. 68% of the respondents had already started repositioning their portfolio as of May and April of 2020. So they're already thinking about how could they position their 2020 portfolio to make sure that they put themselves in a good position. And it seems like a lot of them have turned to alternative funds. And we've definitely seen heavy flows into the distressed debt categories, the long short equities, the global macros seem to be where a lot of these allocators and the family offices that responded to us are saying they're putting their capital. So that's encouraging. And then you did mention Bitcoin. I'd be foolish not to mention it as well. Coming by far the top performing category on the Bloomberg Hedge Fund Index, returning 53% in 2020, up 10.7% in November alone. So it's definitely a pretty exciting time. And I think investors are very much more curious than they would have been in 2017, let's say. And but it's something we're going to monitor as well, because we actually added crypto as a hedge fund strategy this past year.
And in terms of fees, I mean, people often say hedge funds, you look at, we talked earlier about how they compare, and again, you can't use just the S&P 500, but how they will compare, for example, to an index fund that's indexed to an index like the S&P 500. How have fees reacted? Because have fees come down?
Yes, they have, and they're going to continue, I think, to do so, because you see the S&P on this tear that it's been on, and it's tough to justify why not putting your allocation into an emerging market ETF, for example. Why pay 2% to manage your portfolio and 20% on a performance fee? So I think that those days have definitely passed as of 2019, and I think they're only coming down even more because, yes, there's an appetite for allocating to these hedge fund strategies, but at the same time, that's a lot of people who are competing for a limited amount of assets. And the one way to be competitive is, I think, to lower your rates. Now, a lot of the clients I work with would say that undermines the value of the expertise they bring, that they're going to stay firm with what they offer. So I've seen both sides, but across the board, we're seeing performance and management fees come down.
Yeah, and I guess that's good in some ways, but I guess as everything's cyclical, right, Tucker? I mean,
sure.
Things go up, things go down. That's why you have things like sector rotations and asset class rotations. But I would expect that as hedge funds perform better and alternatives perform better, the justification for a fee and a higher fee will certainly go up. I mean, if you can deliver on what you say you're going to deliver long term, I'm not just saying 1 year, right? You've got to be able to do it year over year over year, deliver returns. I would expect that people would stand in line to pay for those fees as long as you can deliver.
Well, yeah, absolutely. And Jeff, so I think the big kicker is going to be when the S&P continues to produce 10%, 15% returns. Hedge funds need to be right there with them. But when the S&P drops, hedge funds really need to demonstrate their value by keeping your investors comfortable with the returns that you're providing. I think really being a true hedge fund is going to be something that is going to test a lot of these asset managers, because if you're just sticking your portfolio in a long only strategy and investors are paying you 2%, I think they're going to catch on quick, and they definitely already have.
Yeah, well, I wouldn't pay for that if I couldn't get the returns. Last question. We go into
or the safety, or to manage your risk better. That's really what they're paying for.
Yeah, absolutely.
It's a crazy time.
Yeah, I mean, I wouldn't pay for something if I wasn't getting it, even in the short run, because the hit to the portfolio is a domino effect. But last question here,
sure.
Tucker, is when you look out into 2021. And here we are, we're this is the day after Christmas. We're talking. What are you thinking about? What is Bloomberg thinking about for 2021, knowing that we're kind of hopefully coming out of this COVID crisis? Things hopefully will clear up globally, economically over time. But what are some key takeaways for the audience to hear?
Sure. First, I want to wish the audience a Merry Christmas and a Happy New Year before we close out. And as we think about this new year, these new beginnings, there's definitely big opportunities for portfolio repositioning, as we talked about with the survey results that we've seen from our investor community. I think the opportunities are going to come a lot in real estate. They're going to come a lot in these distressed debt funds that have identified securities and strategies that they can execute on that aren't available to your typical fund. I think that's going to be the people who can make their investors feel good about where they're putting their capital and safe, because right now there's so much uncertainty. Obviously, the election is now past us, and we think that there's a vaccine on the way. But investors want to always be prepared for the next disaster that's going to happen. And if you're managing a pension fund, you're happy with where things are right now, and I think the hedge fund market is delivering. But you're always anticipating what that next disaster could be, and you want to make sure your assets are in a place where they're going to be protected. So finding managers who can convince the hedge fund that they're a good place to weather any storm, I think, is going to be the key. And the opportunities, I think, are going to present themselves with things like Brexit and with things like, a lot of currency funds that I'm seeing are employing some really innovative strategies that I'm excited to watch. And then particularly the Asian markets, I think, will be huge in 2021. Understanding that the United Kingdom, where I live, is going to be digging out of a hole for a while. The United States is really an interesting place in terms of their economy, but I think the Asian markets present a lot of opportunities and a lot of investor appetite.
Well, we're going to be waiting and seeing, like all of us, like everyone around the world. Tucker, always a pleasure chatting with you. Thanks so much for joining us from Sparta, North Carolina. Beautiful outdoor area.
Good to be with family right now.
Wish you a very happy New Year, and we look forward to having you back on the program very soon.
Thanks so much, Jeff. Take care, buddy. Thanks,
Tucker. Great to see you. Have a happy New Year. And when we come back, some of our best segments for the week. You're going to want to stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Hi folks, Joe Namath here, and if you're on Medicare, this is important. You're now entitled to eliminate copays and get dental care, dentures, eyeglasses, prescription coverage, in-home aids, unlimited transportation, and home-delivered meals, all at no additional cost. Plus, your zip code may have coverage with the Give Back benefit that adds money back to your Social Security check every month. Look, with the uncertainty of the virus and vaccines, you need to get everything you're entitled to. Here's the bottom line. Call to get significant benefits at no additional cost and see if your zip code has coverage with the Give Back benefit. Millions of people have trusted the Medicare Coverage Helpline. You can too. Call now. It's free.
Call 1-800-924-3920. That's 1-800-924-3920.
Welcome back. On Monday, I sat down with the Kogod Tax Policy Center's Caroline Bruckner to discuss tax reporting for independent workers. Let's take a look.
Tax filing this year is going to look very different than it has in past years for a whole bunch of reasons. A lot of the economic stimulus work that Congress funded, both in the CARES Act and that they are putting together with this next round of stimulus right now as we speak, is going to be pumped out through the tax code and reflected on the returns that folks are going to be filing in April of 2021. The forms themselves look different. There is, for example, a new line for folks that take the standard deduction to take a deduction for $300 worth of charitable giving. There are new requirements for reporting whether or not you got a economic recovery stimulus payment back in the spring. And, for folks that, were making claims for unemployment insurance, that income is taxable. And for folks who had never claimed unemployment insurance before, that often comes as a really nasty surprise in the following April. And what I've seen in my own research in tracking the tax compliance of gig workers and independent contractors since 2015 is that even the most experienced independent contractors are not always aware of what their tax filing responsibilities are. I did a survey of experienced self-employed workers who were members of the National Association of the Self-Employed, and 60% of them didn't set aside any money for their tax liability. They hadn't even thought about it, and it wasn't something that was a high priority. Other workers are also going to be on the hook for unexpected tax payments that they owe and aren't going to even get any kind of 1099. If you are a gig worker and you work for a platform like Uber or Lyft or even Airbnb or Etsy, there's a good chance, depending on what state you live in, that you might not get a 1099 unless you had 200 transactions and more than $20,000 in payments, which is the filing threshold for getting a 1099K for that kind of work. One of the things that we've seen develop in recent years, along with the gig economy, is all sorts of tax compliance solutions for individuals that are doing this kind of work to be able to record their receipts and expenses in real time on an app. Taking pictures of receipts and being able to upload them to keep tracks of your books is something that a lot of really savvy Uber drivers or Lyft drivers and folks that have been doing this for a while have really gotten accustomed to doing in order to claim their benefits to offset their tax liability. But those are only the folks that have the wherewithal that they're actually going to be paying and owe money for their self-employment taxes so many times. And in fact, the majority of folks that do online platform work don't get any 1099 and don't even realize that they have to pay self-employment tax on that. So they're, underfunding their own retirement security by not paying their self-employment tax. I think it depends really on whether or not you are a middle or high wage worker versus a low wage worker. And it also depends on how the IRS is able to roll out their voluntary income tax assistance program. I've been a VITA volunteer for the last couple of years, and I'll be doing it again, but trying to figure out how we can help taxpayers who qualify for VITA income tax assistance preparation is, something that I know that local organizations who engage in that kind of work are wrestling with right now. I've heard a couple of public comments by IRS Commissioner Redding that they fully expect the IRS tax filing season to start as planned in mid to late January. But how that looks for VITA programs is going to be something to watch. Now, for folks that are middle or higher wage income earners, they won't qualify for VITA, and they might actually be more inclined to seek tax preparation software or outside assistance in doing their own taxes, given the complexities with the CARES Act just this year. I think that with the incoming Biden-Harris administration, they are looking to get folks help as quickly as possible. We've already seen that with them immediately identifying their nominees for various Treasury and other critical economic advisors. I think that they have been, from what I understand and from reading tweets and emails from former colleagues on the Hill, they've been engaged in pushing to get a final stimulus package out. So I think that there's every incentive to try to help people as much as possible. But given where we are with vaccine distribution, given where we are with the state of COVID cases, it's anyone's guess whether or not it will the current conditions will actually necessitate having to push out that.
And on Wednesday, I also spoke with AAA's Andrew Gross about a surge in gas prices. Let's take a look.
We've seen a slight increase in gas prices, actually, very recently. Gas is now up to about $2.22 a gallon, which is a small increase. But compared to last year, it's still 33 cents cheaper than it was last year. Now, an interesting point, in a normal year, cheaper gas prices, that would encourage people to be hitting the road. We don't think that's going to happen this year. That shows you how COVID is changing the discussion for everything. Historically, it's tough because this pandemic has changed everything. It's just kind of rewritten the rules, particularly for the next, say, 6 months. So we think that this little spike we're experiencing now, that's really attributable to some maintenance issues going on at refineries and demand of people driving on the road is still suppressed. So we think that gas prices are going to moderate a little bit and might slide back from $2.22 to say $2.15 or even $2.14 in about a month. So this little slight spike will ease up in about 30 to 45 days. A lot of folks may be working from home, and this car, if they say they're planning to go somewhere at this holiday season, this might be the first road trip their car has been on in 10 months. They may not have really paid much attention to their car at all. So what they need to do is check the tires, do the simple stuff, check the tires, make sure that they're properly inflated, check your windshield wiper fluid, check the wiper blades. The last thing you want to do is be peering through a smeary windshield in the middle of a sleet storm. So do those little things. And also ask yourself, how old is your battery? If the battery is 5 years old or older, might be time to change it because batteries will fail without warning. You just get in the car, you get that sickening click, click, click noise. You don't want that when you're on vacation somewhere. So let's just try and plan ahead and do a little prep work on your car. You can download the AAA app, and it has triptych planning on there, and it also has there'll be a little button on it, not a button, but let me rephrase that. On the app, you will see, I need emergency road care. You hit that, and it is instantaneous. It's interesting, but with these new strains, there's a lot of schools of thought on it. Some folks who are really, really worried about these new strains, and other folks are saying that this is sort of typical for viruses and that they do mutate a little bit, but that the vaccine will take care of these mutations. It's sort of wait and see, to be perfectly honest. And we're just at the very beginning of the vaccine rollout anyway. Just a few people have gotten it, and only those folks have gotten just the first dose. So when it comes to what we foresee this having an effect on gas prices, probably for the next 6 months, road travel and demand is still going to be suppressed. We just don't see people hitting the road that much for the next 6 months. So that will probably have an effect on gas prices and keep them relatively low.
And that wraps up this episode of BRN Weekly. Have a topic of interest or someone you think we should talk to? Then drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, check out our daily newsletter, The Morning Pulse. Don't forget, we're back again tomorrow for our weekly show, BRN Sunday. I'll be joined by members of the media, academia, and financial services as we analyze all the news this week. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.